Hello to everyone. Welcome to this module section where we discuss the users of investment funds. But before we start to discuss the content, I want to introduce myself to you. My name is Christoph Fricke. I'm working at the ECB Secretariat, to which I'm seconded for more than 2 years from the Deutsche Bundesbank. At the Deutsche Bundesbank and here at the ECB Secretariat, I was working on the macroprudential regulation of investment funds, the analysis of risks surrounded with investment funds. And one of the important contributions myself also for the academia was the development of a macroprudential investment stress test. So enjoy the next modules. I hope you will learn a lot and happy to see you in person in Florence. So what is this module about? This module provides you with an overview about the main users of investment funds. So you can think about, or before we start, let me first make a short disclaimer. So any views I will express here in the presentation do not necessarily represent the views of the Deutsche Bundesbank, the ECB, or its members' institutions. So what does it really mean to discuss or think about what are users of investment funds? So the main question we discuss here when it comes to the users is who uses investment funds, how and why. And to tackle this question, we will first start with a discussion of the economic functions of the investment funds, something which was introduced in the previous module. There we get more from a high-level perspective into touch of who are the users of investment funds. Then we will try to classify investors into specific categories based on given regulation. And then I want to introduce you to specific investment fund structures which cater best for the needs of different investors, which we categorized before. So what you see here is a graphical illustration of a fund's balance sheet. This graph was already introduced by Dorota in module 1.1. And at the top, you see the asset side of a fund. And at the bottom, more or less, you see the liability side. So the different fund units a fund issues and which investors buy. So in principle, you see the asset and the liability side. When you look at the asset side, you get a high-level understanding who invests into the into what are the fund investments. So it gives you an idea when we link it to the economic functions, to whom are the funds providing an alternative source of funding. When you look at the fund units at the bottom, this is the liability side of the fund. This relates to the economic function, the accessibility a fund provides to investors. And that's something we will also discuss. So let's first start with the investors in the investment fund. So this is the liability side. So what you see here in this left graph are the investors. And if you look at the different investor categories, what is striking is that there are two main sectors which invest into investment funds. And these is in light blue, the insurance corporations and pension funds. And then in pink, households and non-profit institutions. So these in the EU, these are really the main investors which provide money to investment funds. You can also see a gray bar. These are non-EA investors. And according to the statistics we use here to produce the graph, these are investors located outside the EU and for whom we do not have any sectoral information. But for those we have sector information, we see that the households and the insurance companies are the largest investors, users for investment purposes of those investment funds. At the right graph, I show you into which sectors the EU funds invest the money they have received from the investors. So this gives you an idea to whom or to which sectors funds provide an alternative source of funding. So if you look at the graph, you now see that the red area is dominating. These are non-MMF investment funds and other financial institutions. So what does it mean? This means that funds invest predominantly in other funds. So they collect money and invest it into other funds. So they make use of other funds to diversify their investments. And in addition, you see that there's the light blue area, which is related to the non-financial corporations. So if you combine both graphs, so you see the investors and the investments of the funds, you see that funds are intermediaries in the middle. They collect money from insurance companies and households and channel it to non-financial corporations, for example, industrial companies, and also use other funds to channel the money further to other sectors. So after we have discussed specific users or sectors which use the funds, let us now try to categorize the different investors. So for the moment, when we only think about sectors, we think about insurance companies, households, but there's also another category beside of the sectoral categorization, which is related to the MiFID regulation. And this is something which now relates investors' categories also to their regulation, into which specific investment funds they are allowed to invest. So let's have a look at the MiFID regulation here. It's Article 4. It differentiates between 3 different investor groups. What you see here most pronounced are the professional investors at the left, semi-professional at the right, and anyone which is not classified as professional or semi-professional are those which are classified as retail investors. So the professional investors are mainly financial intermediaries, legal entities, banks, insurers, pension funds, but could also be non-financial corporations. What's really striking for them is that they are large in size and by the activities in the financial sector. So at least they should have a net turnover of 40 million. And that they have a main activity to invest in financial instruments. But beside of this, so I mean, these are always criteria which apply to banks, to investment funds, etc. It's also that national and regional governments are assigned as professional investors. And these professional investors have a lot of flexibility when it comes to how they can use investment funds or into which risks associated with investment funds they are allowed to invest into. On the right-hand side, you see the semi-professional investors. These are investors which are not assigned as professional investors at the first stage, but they have specific criteria when it comes to the transactions and also to the size, which allows them to qualify as a professional investor. So at least they should have an average frequency of 10 transactions per quarter. They should own an instrument portfolio of at least 500,000 euros, should own a position in the financial sector at least at 1 year. And if these criteria apply, they can request to be also treated as professional investors. And this opens them the door to be more flexible into which investment funds they are allowed to invest. The same applies to professional investors. They are also allowed to request not to be treated as professional investors, and then they are classified as retail investors. What does it mean to be classified as retail investor? As retail investor, the MiFID regulation directly provides strict and prudent rules into which asset classes and which risks investors can invest in. And the main objective here is investor protection. So how do funds cater for the different investors' needs? So we have learned in the last slide that they are professional investors and that they are retail investors. And what you have seen in one of the previous modules is that the funds can be set up separately for professional investors and for retail investors. So you have what is named institutional funds, and these are mainly the alternative investment funds, which cater best for professional investors. And then you have the retail funds, mainly the UCITS, which are sold to retail investors. And the main advantage to have this clear split is that each of the investor categories have different demands for the risks associated with the investment funds, and also have to cater or have to comply with different regulations. But what is also present in the fund sector, and that's also something you have learned from my colleague Dorota, is that there are retail funds which issue multiple share classes, and they are sold to retail investors and to professional investors. But what will be the advantage for the investors if you have a fund in which retail and professional investors are commingled? Funds usually provide professional investors a discount to attract the large investment amounts. So remember, professional investors are those which have the large pockets, which have a lot of money to invest. And it's very attractive for the fund to attract those investors to their fund. So normally they attract them by providing them a discount. So this is the main advantage for the professional investors to be commingled with retail investors. They are provided with an exposure to specific securities, and they pay minor fees compared to retail investors. For the retail investors, the advantage for being commingled with professional investors might be more indirect. So the fund is able to attract more money from the professional investors. So the overall assets under management increase. And due to the economics of scale of managing a portfolio, this means that the overall costs per managed unit or asset is reduced, and this might also translate to the fees retail investors pay. So you see there might be benefits for both sides, the retail investors and the professional investors, when they are commingled together. At this slide, I provide you with a real-life example how the different share classes could look like and how the expense ratio, so what is the average fee which is paid by the investors, looks like for different share classes. So here you see a Vanguard share, or these share classes are usually provided for all investment funds Vanguard provide to the investors. And it starts with the investor shares, which is usually sold to the retail investors. Then you have Admiral shares. You can think about them catering best for the semi-professional investors. And then you have the institutional share class. And there, if you look at the minimum initial investment you have to do, it's 5 million. You directly recognize that this really aims for the professional investors. And if you look at the right column, the expense ratio on the average investors pay for each of those share classes, you see that the expense ratio decreases with the different share classes. So the highest fee is paid by the investors buying the investor shares, usually the retail investors. And then the lowest expense ratio is paid by the professional investors when they sign in for the institutional share class. Now I want to introduce you with another concept, how you can use the funds. So what you have usually in mind when you think about an investment fund is something which is called a commingled account. That's something we have discussed so far. In the previous slide, we discussed that retail and professional investors are commingled together into one investment fund. And that's exactly what the majority of funds look like. You set up one fund and several investors invest into it. So let's go through this graph step by step, what you really see here. So at the left, you see the investors, and the investors bring the money to the investment fund, something they sign in for a specific fund, they buy specific fund units, and this money is put into the fund portfolio, and the fund manager selects and manages the investments. So you really see that there is a value chain, and the value chain is how the money flows. The money flows from the investors to the fund, and the fund manager decides how the portfolio has to look like. This means that the investors really have to think about if the fund and the fund portfolio the fund manager has suggested fits with their investment objectives. If not, normally they will not provide money to this fund. But the decision which securities are selected lies with the fund manager. And then there are the separately managed accounts, and these provide more flexible to the investors in which securities are in the fund portfolio. But if you compare this graph here with the graph before, you recognize that it looks completely different. Why? This is related to how the fund is structured, or what is the main purpose of the fund. The definition of a separately managed account is that this is a fund which is provided for one individual investor separately. There's no other investor in this fund. Why is this beneficial for the investor? In some cases, especially when you are a professional investor, you have a specific investment objective. Maybe you want to have an exposure to high yield bonds. You have a very clear idea what is your strategy, what you want to invest. And then it might not be beneficial to be commingled with other investors, which might have maybe only slightly different strategies, other needs for the regulation. And therefore, you decide to set up a separately managed account. So you define your strategy, discuss this with the fund manager, who takes the investor strategy into account, then reflects on this, proposes an asset selection, and then the fund portfolio will be set up. But there's still the opportunity for the individual investor to adjust specific adjustments. And also there's the benefit that this fund structure can cater best the regulatory requirements of this individual investor. So let's compare these different funds. So you have the separately managed accounts, and you have the retail funds we have discussed in the past, which is one example for those commingled funds. So in the separately managed accounts, you have a personalized asset allocation and risk management, something I explained to you in the last slide. It's a fund structure which really caters best the investor's needs and the regulatory requirements. This can include tax loss harvesting and what's also important for some investors is that they control the timing of the gain recognition. But here, usually, the fees which are paid are performance-based. So it really depends on how good the portfolio performs compared to a specified benchmark. And then if the investor is not happy with the performance or for any other reasons, it has the possibility to terminate the mandate of the manager upon advance. When you look at the commingled funds, it's a little bit different. Normally, the asset allocation is regulated. Think about the MiFID regulation, which directly classifies the investors into specific categories. And with those categories, usually different risk regulation takes place. So the fund structure is primarily defined by this regulation. The tax harvesting is normally limited, as this is the fund which fits for several investors. And then what's also interesting is that there's usually no possibility to terminate the fund. It requires a consent of the majority of the investors in the fund to really force that the fund is going to be terminated. So you see, when you think about the different users of an investment fund, that there's a lot of heterogeneity in the market, and there's not only one specific fund structure and only one specific investor in there. So to conclude on my presentation here, what are the main takeaways of this module? So if you think about an investment fund and the different users of these investment funds, so the investment fund cater for different investor protection rights, the regulation, caters for the investors' investment objectives and also the regulatory objectives, and that investment funds are key intermediaries in the financial system. Here, think about the graph I've shown to you at the beginning, where we have looked at the different sectors which invest into an investment fund and what are the sectors an investment fund invest into. So thank you.